The Pittsburgh Business Report is provided free to the public with contributions from Doug Farrell, makeup artist, Sephora of the South Hills Village Mall, Sabika Jewelry, the Post Office Catering Group, Allure Hair Designs and Mini Spa, Viewpoint Studios.
Welcome to the Pittsburgh Business Report. I'm Donna Kline. Today our topic is managed futures. And to help us understand managed futures, we contacted CTG, Capital Trading Group. The co-founder of CTG is here with us today, and it's Pat Lafferty. Thank you, Pat.
Thank you, my pleasure.
You know, managed futures are a pretty complex subject, but let's start with the basics. What is a futures contract? How do people use them in their investment?
A futures contract, basically explained in its simplest form, is going to be about everything except a corporate stock. You know, an IBM, Apple. A futures contract could be gold, it could be energies, it could be currencies, interest rate instruments. Futures contracts were used originally by end users only, a farmer who wanted to hedge, institution wanting to hedge, and through the years, as education has grown and people have learned a little bit more about what they are, they've really become mainstream as an investment vehicle. So you can actually use these futures contracts to trade in all these different commodities.
They're pretty leveraged, though. Are they leveraged?
They are leveraged, yes, indeed. Most of them are leveraged. You put up about 5% is all of what the actual contract is worth, which means a small move in these contracts could be a dramatic move, profit or loss, for you as an investor.
When you say hedge, that means people would actually participate if they needed to sell a product down the road, they need to buy a product down the road. You can be on both sides of a futures contract, make money if it goes up or down.
That's right. That's definitely one of the big advantage of futures contracts is you can profit from rising or falling markets. And the hedgers, while they may be taking a specific position, if I'm a farmer and I know I'm going to be delivering corn in 6 months, I'll go ahead and sell it in the market now to lock in my price. But that makes up less than a few percent of the entire market.
Really?
Most of the market and liquidity comes from people like you and me and the people who are investing because they're forecasting price direction. I think corn prices are going to go down, so I can sell them now and buy them back later and profit from the difference if I was correct.
Who's in charge of regulating it, making sure the trade's all clear?
Yep, that's a great question. It is regulated. The National Futures Association regulates it. They're the government's regulatory body. And in the managed futures industry, we work with professional traders who manage client assets. Clients invest in them, and then they specifically trade a portfolio of different commodities, whatever their specialty is. And every portfolio manager, which we call CTAs, Commodity Trading Advisors, must be registered with the NFA, the government's regulatory body.
All right, and so they are audited regularly?
They are audited, they are tracked, the results are posted and made public, and they have to update them every 9 months. They go back and they're audited again, and results are posted on a monthly basis, so it's very well tracked and regulated.
It seems to be that a lot of people are starting to allocate money to the managed futures industry. It's different, though, than just allocating money to commodities, say putting money in a commodity fund. There's a difference there.
That's a great point to make. Funds have been in some trouble in recent years. As you invest in a fund, you put money in, your funds are pooled with another investor who you don't know, and then the portfolio manager will invest from there. What's different and what managed futures do is they keep it an individually managed account. It's a segregated account. So you're the only one that could put money in or take money out of your account. The funds are not pooled, and they are completely transparent, which means you can see at any point, at any time, what your account is being invested in and what they're trading.
When you put money in a commodity fund, say an investor allocates money to a commodity, certain percentage, but isn't that dependent? I mean, that particular segment does well if commodities rise. I mean, commodities have to gain over time, but managed futures, the whole commodity basket of commodities could go up or down, and the futures manager can still profit.
That's right. There's about 1,750 registered portfolio managers, or CTAs that we call them, and they can trade over 150 global markets anywhere in the world. They can take positions for prices going up or down. It gives them incredible flexibility, which is what makes it really unique. And dramatically different and an advantage, I think, as opposed to the investment days of old. 20 years ago, you just buy and hold something, and nowadays because of the specialty markets and all of these global markets and access and electronic trading, these professional traders can hedge action taking place at any point in the world, politically, economically, natural disasters. They're able to immediately, take positions in rising or falling markets to, give your portfolio or whatever their specialty is, whether it's precious metals or currencies, whatever, to give them an advantage for that price movement.
When you look at the last 20 or 30 years of performance of managed futures, overall, like a weighted average, I guess, would it be, of CTAs, they've dramatically outperformed stocks, international stocks, bonds.
It's shocking, actually, to see the chart. When you look at over the past, let's say, 28 years, 30 years, managed futures have outperformed not only the bond market, the international stock market, the domestic stock market.
Now, what happens, I know you have another chart that we could put up as well that shows a standard allocation of a portfolio, stocks, bonds type allocation, versus adding a certain percentage of managed futures to the basket and the performance over time.
Yeah, that's correct. There's been many independent studies from different institutions. Nobel laureates have also done this study where a typical allocation of 20 to 30% of an investment portfolio will substantially not only help reduce volatility in the underlying portfolio and risk that is attributed to it, but also it enhances performance. In some cases, over a 10-year period, a 20% allocation increased the return by 50%.
And it smooths out volatility, which is something we've experienced. The stock market
Yes.
down over 50% in over about a year's time recently, rallied 74% off of its low. We've had extreme volatility. Do futures, the index in general, the overall performance, has that smoothed out some of that volatility in the last couple of years?
Well, only if you've invested in it or diversified into it, it has. But absolutely, there's never been a better time to, add managed futures to your portfolio for that reason. I mean, the conditions right now in the investment community are so unpredictable, so volatile. You're right. We've been on a nice, smooth up trend in the market for so long now, and then all of a sudden you wake up, and the last 4 weeks have been, a nightmare for a lot of investors, where they've seen 10 months of rally disappear in 4 weeks. So that's the benefit of diversifying in managed futures. And you shouldn't put everything in it. You don't switch to managed futures. When you see the chart that we put up and the dramatic difference, it doesn't mean, hey, I'm out of all my stock portfolio and I'm going to manage futures. What it means is you educate yourself and you find out if this is something that will help you and add to your portfolio, to the overall returns, to smooth out the volatility that we're talking about.
Now, we showed a lot of charts about the CTA index. Now, that is all of them kind of pooled together, their overall performance.
That's right.
So the true question is, how do I find a CTA that's going to have steady performance? I mean, there's no guarantee. You're actually putting your money with an individual, not the index itself. So
that's right.
What's involved with that kind of decision?
That's a great question. There are several different sites and companies that monitor and audit and track the performance of the, as I said right now, registered 1,750 CTAs in the U.S. here alone. So companies like my company, Capital Trading Group, will monitor and track these, and then we'll filter, see which is the most attractive, which we like better, which ones have the least amount of drawdown, which ones have been around for 2 or 3 years or longer. There's a lot of different criteria you can use to filter through the best, to get to the best CTAs, and then we'll make recommendations to clients based on what they're looking for.